To the opening green shoots of 2022. So coming at you live from Bridge Plus in Singapore. So we started Green Shoot series during the dark days of lockdown way back in 2020 to support the founder community, and since then we branched out and had industry leaders such as Joseph Tsai, the MD of MAS, Ravi Menon, to Piyush Gupta, all contributing to this program. So my name is Pat Patel, and I lead the International FinTech office at MAS and also Elevandi, a company that we've set up to drive the growth of FinTech and investment in Southeast Asia and beyond. So we do this by connecting people and businesses, connecting ideas, and connecting insights. And this year, you can expect to see a regular monthly Green Shoots episode, and of course, the Singapore FinTech Festival, which we really hope is going to be in person this year too. And for the first time this year, we'll be introducing the Point Zero Forum in Zurich. This forum is organized in collaboration with the Swiss government to unlock capital for founders and bring the public and private sectors together to frame new opportunities arising from Web3, embedded finance, and sustainability. So the focus for today is on the FinTech funding landscape. And not a day goes by without there being an announcement from a startup raising an obscene amount of money, or larger corporates making big bets. So we're seeing a maturity in FinTech globally, and there have been multiple exits already in the last few years. But let's not be fooled that the streets are paved with gold. There are tailwinds ahead, and we are seeing a market correction which is likely to happen over the coming year or so. So while going public is seen as the ultimate goal for a number of founders, it no longer appears to be clear-cut, especially as a number of tech giants in the East and the West have begun to see a slump in share prices as geopolitical tensions increase and inflation continues to rise. So understanding and framing the landscape and opportunity is the focus for today's session. So before we kickstart today's session, let's take a look at the agenda. And so we have a cast of superstars here for you today. So I hope you've got questions, those in the audience and also online. So without further ado, I'd like to introduce our very first speaker, who's going to provide insight on the 3.3 billion raised by FinTechs in Singapore in 2021. And she'll also talk about where we are today and what we can expect for the remainder of the year. So please welcome the head of Asia at BCG FinTech Control Tower, Pauline Wray. Welcome to the stage.
Awesome. Thank you very much, everybody, for coming today. I think on top of having our first sort of live event, we've also got some news that Singapore is opening up in a big way, so very excited. Right, so today, what I really wanted to talk to you about was just the funding that we've been seeing in 2021, as well some of the geographical movements as well, which are really exciting. And as well as every industry, you see competition growing through technology. And last year, FinTech received so much attention and interest because they were there, right? They were there to answer the fact that we needed to transact. There's no surprise, Boston Consulting Group, I have a lot of slides, although Pat and Rebecca did a good job in cutting almost half of it. But we'll get through it in 15 minutes and just get a sense of the madness, the roller coaster that was 2021. You know, what funding FinTechs are attracting and the context that it's doing it in. So let's kick off. So 4 takeaways, right? So we have, first of all, the fact that globally, FinTechs attracted $131 billion. And not just in a specific country or specific region, just globally. That growth, as you can see from the Americas, EMEA, and APAC, was just massive. In terms of the difference between 2020, 177% growth. The ticket sizes were bigger. That the growth was coming from mega deals, and you'll see, I mean, it's just The concentration of mega deals as well is astounding. Some real icon companies are being built today. And in terms of the clusters, you know, we're used to thinking about payments, right? Payments, buy now, pay later, but actually all of the clusters saw a huge amount of support of capital to really develop. Now, despite this, you know, nice chart, it looks very boring, but it's a really important one. Although not visible here, there has been a shift from public to private investments in financial services. And finance, as a percentage of the public market, actually has dropped. The real finance innovation activity are actually the folks in this room, are the entrepreneurs, who are really building amazing companies. And with this push, this huge amount of capital going into the space, I'm actually pretty excited about it. In addition, I would say that FinTech, as a proportion of funding in venture capital, compared to other sectors, has really been meaningful. In 2007, for example, it represented 5%, completely meaningless. Today, it's more than a quarter. So really excited about this shift, which is both visible in the competition, the talent, the new markets, and also the opportunities that are being created. So where is the funding coming from? As you can see from this chart, mega rounds. Huge amounts of proportion of deals which are 100 million and above. Again, after the COVID outbreak, we saw massive amounts of capital, providing the capital resource for ecosystems to further push the spread, to the adoption and the reach of actual fintechs. Now, in a world where fintech competition is now very powerful, fintech vertical champions, as you saw, you know, you have payments, you have digital challenger banks, you have lending. They are now also rebundling things across financial services. And actually, I have a question that I wanted to ask, because we were just in a chat group earlier, and somebody asked, you know, what crypto apps do you have? And somebody in the group actually had something crazy like 7 or 8, was it? And then I have and financial apps even more. So how many in the group have between 1 and 5 financial apps? 5 and 10? Nice, nice, nice. 10 to 20? Yeah. We have a problem. So, you know, there's about 6 seats of financial apps on a phone. So I think, honestly, it's really telling and pretty exciting. So now about where is the money going to in terms of the stages. I think this is actually also very comforting to see that every stage is being supported by funding, you know. An idea and a spreadsheet all the way, you know, to maturity. Then I think one of the pieces that also are really important to note, and we'll see it when we get to the specific markets, we're seeing icons being born. And in emerging markets, the teams are better and they want to build. The direction of travel, to me, honestly, has been illuminating. As it spreads across the world, right? It's not just the Americas. You don't have to be just in Silicon Valley, or you don't have to be in specific, you know, global financial centers. The fintechs are increasing industry efficiencies and also democratizing the access to financial services. And there's a lot of data, so we will be actually sharing the slides after. So what are banks doing? They're hiring consultants. Actually, look, there's actually less evangelizing that one needs to do. Populations are digitally enabled, and banks are investing, and most banks are engaged with fintechs, but actually it's not an easy experience. I think most of you probably have an experience, bad-ish experience in terms of working with banks. And this is for a lot of reasons, right? unclear conflicting mandates, multiple arms, overlapping objectives, no definition of what success is, the strategy not being clear, operating model, right? I mean, conflicts, again, on how you measure success, gap in capabilities. I mean, this is a big one. Also, they have difficulties in recruiting top talent. And compensation also not always aligned with that typical entrepreneurial opportunities. And the other one, I think that's also really important, is about just generally, the fact that these things are not projects, they're products. So for that, I think there's still quite a lot to do. Now, emerging markets, I think this is something that we really wanted to highlight here because the data is saying so. So in terms of the volumes in investments, they have global reach. And it's not just payments, it's lending, it's trading, it's investment, wealth management, financial health, insurance. It's no longer a financial hub thing. FinTech has truly gone global. Smaller hubs have a concentration of FinTechs as well that have been receiving, the majority of the funding. If you look at Africa, for example, Africa has just under 700 FinTechs, of which 80% of the funding, 80-ish, percent of the funding is concentrated on top 10 FinTechs. But this is actually a trend that we saw a few years ago with some of the larger financial hubs. And what this does is that it creates entrepreneurs that are able to exit, they have that experience, and then they invest back into the ecosystem. Now, in terms of the leading countries, if you look at Asia specifically, so we're going to skip all of the other regions, but if you have any questions, happy after to speak. So let's double click into Asia. So obviously, payments and lending continues to be a sort of amassed concentration of funding, so 50% of it. But if you look closely, you have trading and investments, which is starting really to grow. I mean, from 2020 to 2021, that was massive amount of growth. And if you start looking at the different countries, you have in India, the FinTech space really took off in 2021. You have as well in China and Korea, which are the third and fourth largest region by funding, have registered actually the lowest growth, but still some growth with 23 and 14%. Indonesia, also very interesting. We saw 68 deals, which reached $1.2 billion, especially in trading solutions. And then we have Hong Kong and the Philippines, who also experience actually the biggest growth, almost 400%, but the funding was concentrated in about 10 FinTechs, 90% of the funding actually. And then Malaysia, finally, actually not a lot of growth, but we saw quite a lot of concentration in two big deals, TNG and BigPay. All right, so again, we will be sharing the slides. There is quite a lot of information here, but I think what I'd love to point out, it's the fact that, in the same sentence, we have India and Singapore. India with 1 billion population, we have 6.5 million. And I think, we push above our weight there. Singapore growing with triple digits, reaching $3.3 billion in funded, really boosted by trading and investment, $900 million in there, and then payment solutions. And I think this is super interesting because it also says a lot about our footprint as a financial hub. And I'm going to do a shameless. If you want to know more about Singapore, there's honestly a fantastic book on Singapore, the FinTech Nation, which really talks about the moment that the idea came about creating this ecosystem, the FinTech Festival, all of the players, the associations, the banking association, the banks that came together as well. So super interesting with our friend Varun, who will be speaking in the next panel. So shameless. Okay, so again, this is just to give you a bit of an overview where we stand in Singapore. Now, in terms of the product landscape, pretty interesting here. So again, trading and investment really saw a massive amount of growth. And amongst financial services, typically, the growth cluster has always been payments. And this year, interesting to see the growth rate and money going into trading and investment. So this is surprising, and it has always been considered super complex. I think anybody in trading and investment felt, nobody, there's not really a threat in there. So 2 reasons for the growth. 1, strong retail interest, especially those providing crypto access, neo-brokers, exchanges, crypto wallets. And 2, investors really capitalized on this interest and gave fintechs special extra love to acquire customers and grow. So here you recognize some of these icons. One of the pieces that I wanted to show as well in this slide and the next one is the fact that so when you look at trading and investment, then you have subcategories, right? And in those subcategories, we saw the biggest growth coming from digital assets custody, retail trading brokerage, and pre-trade fintechs. And there's 2 in particular that I'd like to call out, which is retail trading and brokerage, which raised $11.2 billion in 2021. This is like 60% of the total funding if you go back to the year 2000. And cryptocurrency exchanges platform accounted for 40% of all of that funding, and 50% were mega rounds. And this obviously FTX is one of them, which raised 2 rounds, 1.4 billion, 2 rounds. Post-trade, including digital asset custody there, where you see at the top left, has seen a jump in funding with year-on-year growth of 827%. A lot of, strongly driven by this digital asset custody solution, which received $1.7 billion. Fireblocks raising $933 million across 3 rounds in 2021. So finally, okay, almost 2 minutes, exits. So we actually saw quite a large amount of exits, despite the fact that actually valuations were very high, 60% year-on-year growth of M&A transactions. M&A deals were carried out globally, as you can see there, by corporates, incumbents, fintechs, insurtechs, payments, payment rails, you name it, to really expand operations, share wallet, and strengthen the technology and the product offering. And banks are more active as well. Even those who haven't been engaged or saw it as strategic actually are really showing interest. Again, we'll share those slides, just some fun who bought who sort of picture. Now, we're going to talk about, especially since we have a fantastic panel that are going to be talking about exits and the options that we have in there. So actually, 2021 saw quite a large amount of exits through the traditional IPO vehicle. And when you look at the performance of fintechs and insurtechs in the space, we saw a drop of 31%. When you look specifically, so since we've broken down at the highest level fintechs across, accounts, financial infrastructure, insurance, and so on, you can see which are the areas that have dropped the most. So insurance, obviously we're all keeping an eye on Lemonade and so on, and financial infrastructure. So there's despite, I think one of the big questions that we're going to see is valuation, right? Are we in a space where valuations were too high? Is that public market sort of blip going to translate in the private markets? That'll be interesting to see. Potentially also the opportunity for more acquisitions and everything to stabilize a little bit. So now in terms of, if you look at traditional IPO and SPAC, also a really interesting piece that we built using data. So if you look at all of the fintechs that use those 2 vehicles, you can see the performance is also very different between traditional IPO and SPAC. And this is really, the underperformance really comes down to the valuation, right? So IPOs are, so SPACs, sorry, the valuation is a lot higher than traditional IPO. And there's a number of reasons that we listed there, like the one I just mentioned, revenue projections, the fact that they haven't really also experienced, a downturn, and also the management. So quite an interesting piece, and I think, the question remains, is it maybe just a recalibration? So pretty interesting. Finally, we're kind of 23rd of March, and we are in a whole different ballgame in FinTech. The exciting thing is that it is a global opportunity, as you saw it. It is geographic. It is touching every sector of society, and there is incredible opportunity. And I think we will see the weak from the strong as well emerge. The right side of, so actually this is a quote from Matt Harris from Bain Capital, which I absolutely adore. So he says that the right side of history in technology-enabled version of anything, and you want to be on that side. And I think this is particularly true to financial services. So I guess the question is, will cash continue to be easy to raise at a price point and a frequency that we saw in 2021? À savoir. Thank you.
Thank you, Pauline. So I think one of the highlights of that presentation, and there were lots of nuggets there, is that in the first 2 months of this year, the amount of FinTech funding raised is close to the levels that was achieved in 2019, which I think is a phenomenal achievement to date. So up next, we have three of a kind. So what happens when you bring together an early stage investor, a serial founder, and a man who has multiple hats, from connecting people, to angel investing, to authoring books, to mentoring founders? Quite simply, you get a session focused on the early stage community. This session will focus on framing the early stage startup scene today, highlighting the current challenges, and what we can expect over the coming years. So please welcome the founder and CEO of AAA, Eric Barbier, the partner at Saison Capital, Chris Sirise, and the man with many hats, the Chief Growth Officer at Singlife with Aviva, Varun Mittal. Take it away, boys.
Thank you, Pat. And thank you, everybody, for coming. And it's great to have like an in-person event. And building on to what Pauline mentioned, how Singapore has been scaling, how opportunities have been growing around public markets. And as we kick forward, I wanted to start with a very simple analogy on the public markets. It's said now, you are sexy until you are public. And considering that most of the FinTech IPOs are trading below the values they listed, the first question I wanted to put to Eric and Chris was, with this market where public markets are under pressure, what happens to the private markets? Do you see a lot more demand because people are freaked out about public markets? Or where do you see it happening, considering the world is lost? It was never lost as much like that in my lifetime, at least.
On my side, I'm lucky to be in the crypto space, so I'm getting still a lot of interest in terms of fundraising. So we haven't seen, and because we're very early stage and we haven't raised outside money yet, so we're years away from our IPO, so we really have time. So really, this is not a kind of conversation we've been having so far. It's true that people are careful, more and more careful, because the valuation as we saw, were really, really high. But that's something I've been always doing as a founder, was to really price decently. Having decent valuations. I'm not a big fan of crazy valuations with crazy amount of money. I'm more of an old style guy where we need to get things done in a proper way.
Old style and efficient, super efficient. And Chris, considering you are in a very unique position, you're backed by Credit Saison, and you're at VC, and you're LP in different funds as well. So you have like different permutations from that perspective. How do you see that the public markets winter impacting the private market space?
Yeah, so I think the public markets get affected first because it's the most liquid asset, right? So it reacts to the macroeconomy fastest. And then the effect flows downwards after that. So us being all the way at the other end of the spectrum, being seed stage investors, the funds that we invest in are also mostly seed stage investors. I would say we haven't seen that effect yet. Anecdotally, I think valuations are still very much similar compared to maybe 6 months ago. But what we do expect is to see valuations start correcting. I think they have started correcting in public markets for sure. They'll start correcting in growth markets as well. I think early stage will be impacted as well within the next 6 months. But maybe like what Eric said, I think crypto is in a world of its own. And also crypto, I think, is so nascent that the net growth might outpace any reduction in growth anyway. I think the same principle might also apply to certain emerging markets like Southeast Asia, or I guess tech as an industry globally has never really seen a reduction in growth, in net growth. So I think for Southeast Asia as an emerging tech ecosystem, we'll probably still see growth, just a more tapered or decelerated growth.
And Chris, you mentioned the growth and the valuation side. So one thing which I see, because I talk to a lot of founders and VCs, is this huge competition between the Eastern capital and the Western capital. So now a lot of Southeast Asian startups are raising money from US investors, Y Combinator, and they come up with very different terms and their metrics. And for them, this is, okay, 5% of our portfolio is an Asian moonshot, and they would come up with terms, and that creates a kind of competition. So you have 3 layers of competition. You have local operators, community investors, you have local VCs, and you have internationals, and you have 3 different tiers. And so as a local VC, do you see like that kind of where at least the Western capital will come at sometimes much, much higher valuation because they're pegging it to very different terms?
Yeah, I think that does happen to some extent. But I think the priority is always the founder and the founder's viewpoint, right? So I think what matters at the end of the day is every founder has to optimize for having investors on the cap table that are basically good at different things. I think having a mix of local as well as global investors, usually American funds, is a good approach because they're basically good at different things. I think one very common synergy is that the local funds usually would be more familiar with operating in the local context. So, for example, having more networks to help with hiring of senior executives in the local countries, having more knowledge around the nuances of dealing with regulators, for example, or even just having operated in a similar environment, right? Whereas the investors from more developed ecosystems tend to have the advantage of having invested or interacted with similar companies operating the same business model in the more developed ecosystem. But they might lack the context as to how to translate that or localize that. So I think both bring different value add to the founders and can be helpful in different ways. So as much as possible, I do encourage founders to try to maximize the value of their cap table that way. Yeah.
And Eric, since investors are chasing you right now for your company, and I know at least like 7 VCs are trying to be part of AAA's investment journey. So as a founder, how do you balance between which are the local community, local operators, founders, angels, the local VCs, strategics, and the Western capital? And it's fun to ask a French person since all the big money is coming from the American VCs.
Yeah, I've been in Singapore for 20 years, and one of the only problem of being in Singapore is that some people put you in a corner, saying, hey, because you started your company in Singapore, it's supposed to be about Asia. And typically the local VCs and so on would also say, hey, maybe you need to start with Asia first, and then you can go more global, where all, my previous company, Transfer2, now Tunes, AAA, there is no, especially with crypto, there's no boundaries when it comes to money transfer and so on. So and so I think it's important for the for both the local VC community as well as the global one to understand that you can build a global company out of Singapore.
It's very important to look at from that lens of the things, and the related part to that, which Pauline was mentioning, the overall fintech community here. Where do you see the role of like local community networks to come together to form, to support these founders from that perspective, because they can then bring overall access to networks, visibility, experience. So where do you put the local grassroots networks in your journey from that perspective?
It's been amazing. So I'm old enough to have survived the dot-com bubble, but more importantly, when I started Transfer2, that was 2007, I started to get traction 2009. So not only was it difficult because of the crisis, but Singapore had zero local VCs at all. There was no, fintech as a word was not even existing. And when you're seeing what has changed so much in less than 10 years, where you have all this amazing ecosystem where you can work with partners, even in a new environment like crypto, there's already plenty of partners we can work with. That changed completely how fast you can go, and that's really a tremendous advantage for Singapore, as we saw in Pauline's number just a minute ago.
And Chris, you work a lot with the local grassroots angel networks. You run one as well. We'll talk about one more later. How do you see that the VCs collaborating with the local grassroots networks and angels from that perspective?
Yeah, so one thing we strongly believe in Saison Capital is basically the ability of operators to help founders. We do think good operators are a huge value add to founders, especially if they have operated a similar business model or in a similar geography. So we can't possibly have all those skill sets within the firm itself. So I think working with angel networks is very important. One of the gaps that we found in Southeast Asia was basically vertical-specific angel networks. So basically it was a grassroots effort where we worked with a few friends, and then we started a FinTech angel operator community. That's basically a network of angels who are also operators in the FinTech space, usually founders or senior tech executives. So that basically enables us to bring on certain angels that we feel might be helpful to our founders, or also vice versa, if they are angel investing and they think will be value adding to the founders that they are backing, then we will get involved as well. I think from a more macro perspective, it's helpful for the ecosystem because we are rather nascent, but we are reaching a point where basically angel investing is starting to become more and more prevalent, right, and more mainstream. People have easy access to things like angel lists. Angel investing is definitely talked about more in mainstream media. And we also have some tech executives who have become more successful and so in a position to recycle that capital back into the ecosystem. So we do feel it's a healthy transition for the ecosystem as a whole, and we want to support that education.
So that's really helpful. And building on...
Varun, can I ask you a question? Because you're a very big investor, angel investor in this part of the world. What did you see changing in the last two years?
See, a couple of things from the angel investor side of the things has been the quality of founders from that perspective, the maturity of founders. So till 3-4 years back, it was an accelerator-driven economy. Singapore was very much an accelerator-driven economy. We had about 12 accelerators churning out 70 to 100 fintech companies from them. And the accelerators would take 7% equity for 120 or 200 or max $300,000. So what that would do is, so that generation of the company, there was limited opportunity for angels because you already have diluted that much on that, and then you're dependent on that platform, on that service provider for the future. So the first generation, so I would say from 2015 to somewhere like 2017, was the Accelerator Generation. And from then onwards, if you see, there are very few accelerators now left over. Some of them are the corporates paying somebody to do the corporate innovation side of the things, but it is no more 8 companies coming together, putting 100K, 200K, 1.6 million, give somebody money to run. So that flip where it did not become an industry, it did not remain an industry, and where actual operators would have opportunity to create outcomes, and where their money is valuable, the access they create is valuable. So the real flip was and Singapore FinTech Festival was a huge, I would say, driver for that. So 2017 was the first time where Singapore FinTech Festival had the Investor Summit. And at in that first iteration, there were 400 companies which came out to pitch to different investors. So 2017 and 2018, when Singapore FinTech Festival democratized that access from the founders and the angel investors, that set up that foundations for that stuff to like turbocharge from there. And I would say 2020, 21, exit starts to happen. And that's something which started to, as Chris mentioned, that started to recycle the capital back. So a bunch of founders I work with have exited, and you exited one, so which you've been through that journey. I exited one, and then the 2 more where I was investor. So that exit starts to create that loop. So some of those, I would say, community things is what brought us to where it is. And again, we've been fortunate that like 2 years back when we brought FinTech Nation book, where Saw, Pat were all very supportive of having a national story. We've reached a point where now founders have come together and said, we want to create a grassroots movement to support the FinTech Nation story forward. And again, I think it's a perfect moment to share that like the FinTech Nation book is now moving towards becoming an investment syndicate. And AAA would be the first company the FinTech Nation syndicate would partner to support them in that journey. So that iteration from where a story becomes a community, becomes an investment syndicate, has been an outcome of how MAS came together to say, okay, here are these building blocks we will back. These are the community infrastructure we will build so that the next generation of innovations can be built on top of these. And another point which, Eric, you mentioned earlier, because we talked about exits. So one challenge which I have seen till today, Singapore, no FinTech has exited above $100 million at that time. Now the FinTech you exited is a unicorn. At that time, it was less than 100. And one of the challenges which is said for that is either you sell before 100 or you cross a billion, you become a unicorn and you go public. There is this a wedge between that 150 million to a billion mark. How do you like guide your founders around navigating that? I mean, is that something you expect to change now? Is it a thing of past, or do you expect that 150 to a billion mark to be still there?
Yeah, so I do think it's changed over time, and the circumstances back then were quite different. I think the main thing that has changed is basically the funding infrastructure available to founders, right, at all points of the company's life cycle. So I think any ecosystem starts off the same way. Usually seed funding is scarce, and then the early VCs start popping up. Most are smaller funds, so then the seed funding bracket starts getting filled. Then Southeast Asia, maybe about 4 or 5 years ago, had a growth funding gap. So that's where your B stage companies found it very difficult to raise. And I think that's the years where basically those 100 mil exits happen, because basically there was this gap in terms of funding for the life cycle of a company. I think now pretty much most of the company's life cycle when it comes to financing has been filled. Maybe at the listing side, I think that's where we are starting to see some trailblazers figure out what the best option is. But I do think the circumstances are quite different now. Most VCs working with early stage companies are also a lot more knowledgeable about preparing their founders for fundraising in the future. So I do think the circumstances are quite different. And we also, on the acquisition side, have a lot more possible acquirers, right? So more corporates are looking at the tech space for acquisition opportunities. There are larger tech giants now, both locally as well as globally. They are looking at Southeast Asia for acquisition opportunities. So I do think it will change significantly.
Interesting. And Eric, you are on the other side. So how do you plan, from a founder's perspective, your exit strategy? Like, are you looking at like a short term? You're looking at an ASEAN play, or you're like, okay, I'm going to build it to list, and probably crypto, so you may not list it. You may just do a IEO, STO, or whatever is the latest version of that. I don't know what's the latest version. It changes. There's a flavor every month.
Yeah, I'm getting older, and I managed to do a couple of exits in the past. So I'm not in a hurry to exit. So I would love to see this going through something really big, like ideally an IPO. That would be really the goal, because I fully agree with you is that as soon as you reach a certain valuation, it's going to be very difficult to get acquired. So if your goal as a founder is to sell the company, you'd better not grow too big. And not to raise too much money. Sorry, and that's always the thing. Some people, just because they read TechCrunch and this kind of headlines where huge amount of money being raised and so on, but sometimes for the younger founder, they have to realize that the interest of the founder and the interest of the VCs are not fully aligned. While when you're a founder, your goal is to make a substantial amount of money, where the VC wants to make a lot of money, even if it doesn't happen so often, where the founder wants to have more chances to succeed. So that's the kind of thing people need to. That's usually my advice I give to early founders is raising money is not a metric of success.
And usually I say, like, the founders would want to swing for the fences, but the VCs would want to hit it to the space park straight away. So Chris, how do you guide your founders? Because from your perspective, you would want to literally like hit them, get them to hit out of the park. And what's the right balance from your perspective? And how would a VC look at it? As Eric mentioned, that incentives are not always directly aligned.
Yeah, I think one, it's important to first recognize that not every good business is a venture backable business, right? Because of how venture funds are structured, basically VCs are looking for investments that can return the fund, and so investments that have a very high ROI and also a high ROI within a certain time frame, right, which is the fund's life. So it just means that the company needs to be able to scale fast within that certain time frame, and then have exit opportunity within then. I do think not all good business models fall within that bucket. So I think that's the first thing to realize. When we do meet founders that are strong founders, building what we believe will be a strong and good business, both from the founder's financial perspective as well as contributing to society and building something useful. Sometimes it's not something that we feel will be venture backable, and then we're honest about it to the founder. And then we only invest in companies or business models that we believe align with our returns profile. Right? So ideally, the founders that we invest in would have a similar mindset. Mm-hmm. I do agree, at the end of the day, the incentives are not 100% aligned, because after all, VCs sort of have their eggs in many baskets, or have many eggs in one basket, but for the founder, that's the one baby, right? So I do think the job of the VCs is just to support as much as we can and recognize that the founders are the superstars at the end of the day. But of course, at the start of the journey, we try to find founders that I think are as aligned as possible.
So and I think what's interesting for early stage funds is it's true that they tend to be way more aligned compared to later stage VCs.
And another part of that is also how is that aligned to the teams? Because the third element is the teams and what does the exit mean for the teams? So if you look at from that perspective, so what fails? We've talked about what happens for the good. So can you share any example or story of stuff which fell apart, where the exit was the outcome and stuff fell apart because you tried to raise too high, or you were riding a tiger and you did not know how to get off it? Maybe a global call, Tiger Global.
I was mentioning briefly the dot-com era. So I remember times where we had to do down rounds in 2002, 2003, and that was painful. And liquidation preferences kicks in. And so this means that there's not a lot for the common shareholders.
There was this big debate in our local WhatsApp group on liquidation preferences. So Chris, you tell us as a VC, how common are liquidation preferences? And are these 1x, 2x? And where do you see as a VC these liquidation preferences?
Yeah, so I think liquidation preferences tend to be a function of the market. So I've been in the Southeast Asia VC scene for maybe the last decade. And I've basically seen liquidation preferences evolve from more than 1x participating preference, meaning the VCs get to double dip, right? To the current stage where it's basically a market norm to be non-participating, right? And then in some cases, there aren't even liquidation preferences. So I just think it's a function of the maturity of the market.
And is it different from other markets? So would the US be very different from this?
Yeah, I do think more mature tech ecosystems in general tend to be more founder-friendly. That comes with, one, the availability of capital. So I think VCs are just forced to be more competitive overall, and hence more founder-friendly. But also the difference in dynamic is with more available capital, theoretically the risk of investing early stage also goes down. So there's less of a need for the VC to protect their capital. Right? I think the other dynamic that comes into play also is basically how optimistic the macro market looks, right? And I think we basically had the last decade of the macro market that looks quite optimistic. So I think things have just evolved to be more of a risk-taking nature rather than a capital protection approach.
So thank you so much for coming, Eric and Chris. And one of the big takeaway for me is probably the greatest time to be a founder, with local community ecosystems, exit opportunities, the ecosystem in Singapore maturing, and setting ourselves for success. And Pauline keeps showing us that 2022 has started for a big bang. So we look forward to a great 2022. Thank you, everyone.
Thank you, Varun.
Thank you, gents. I think that was a great conversation. A couple of highlights from myself. It's good to see how the investment ecosystem has started to mature somewhat. I think the funding infrastructure is also improving, which is great. I think there was also a piece around breaking the glass ceiling of 100 million exits, and I think we'll try and cover that a bit later today. And then there was a great quote from Eric, which I'd kind of like to touch upon, and that's around raising money should not be a measure of success. And I think that's certainly something I hope everyone at home, but also in this room today, can start to really chew on that quote for a bit. So for our penultimate session involves a figure who is larger than life. Not surprising, he also has a few jobs too. There's also a pattern emerging here, because we've also had a few people that have at least 2 or 3 jobs at the moment. This session will focus on everything you need to know about SPACs in 2022. So please welcome our Elevandi board member, the partner and head of Asia at Tikiao Capital, and the CEO of Pegasus Asia, Neil Parekh.
Pat, thank you. Sop, thank you. Becca, thank you for inviting me here. It's a pleasure to talk about a subject that Pauline said, if you do an IPO through a SPAC, you'll go down. Now, I think trying to extrapolate US data into Singapore is always going to be a hard proposition, and we hope, and the next session is going to be a very interesting one that involves a couple of good friends in Eleanor, who's also chairman of our SPAC, or chairperson, and our fearless CEO of the Singapore Stock Exchange, Loh Boon Chye. Now, SPACs have been around for a long time, but in the Asian context just came to vogue, I guess, in the last 12 months since a consultation paper was put out by SGX, and subsequent to that, Hong Kong has also come out with rules. So I have a couple of slides that I'll go through very quickly. I'm fully aware of the fact that I'm between two very interesting sessions, so I'll keep it brief, and then perhaps we have some time for Q&A later. So how do SPACs work? I think there's a lot of rhetoric on SPACs, but the reality is many people don't understand SPACs. So very quickly, SPACs work in really two parts. First is the IPO, where a sponsor comes together, brings a team together, has an IPO processed and marketed, and then closes the deal and puts the funds in trust. So as you may know, in the Singapore context, 3 SPACs have been done. I think in the Hong Kong context, a SPAC has been done. And I'm bringing up Hong Kong because I believe numerous people from Hong Kong have signed up for this event. Now, the goal at that time is to make sure you get as diverse an investor base as you can, and as sticky an investor base as you can. So from a sponsor standpoint, get the funds done, the capital is raised, and you have 2 years after the races trying to get an acquisition done. So once you get the money in escrow, you are off to the races. You can call it speed dating, you can call it speed deep dating, whatever you want to call it. But the fact is, all the folks you know and all the folks who know you, you get into a deep discussion on whether it makes sense for the SPAC. Now, the way the business combination works is you have a few choice sectors. So in our case, in Pegasus Asia, we have defined 4 sectors that we are focused on, including financial services, FinTech. And you have a conversation with folks who have an enterprise value at that point of time that would be of interest for this special purpose acquisition vehicle. So for example, if you have, say, hypothetically, 150 million in escrow, and you're hoping to do a pipe of another 150 million, that means the entity that you're looking to acquire and be a minority investor in should have an enterprise value that can absorb 300 million, and still the SPAC would remain a minority investor. So you can do the math yourself. You're looking at a certain size, which is closer to 1 billion Sing. Now, the transaction has to be completed in 24 months. If you don't complete the transaction, before we say don't complete, at the point of de-SPAC, the shareholders in the IPO have 3 options. They can remain shareholders of the company, they can sell their shares in the open market, which they can do anytime, or they can return the shares in the per cash amount per share in the escrow. What does that mean? Or in trust. What does that mean? So the 150 million hypothetical number is earning some interest. So obviously, the value of that 150 million is somewhat higher. Interest rates are going up, but they're still fairly low. So if a transaction, at that point of time, the shareholder can determine whether they want their investment back or they want to stay on as an investor. So this is a capital protection which is perhaps unique, where you get to play in an IPO. At the same time, you have a second look and say, if I don't like the de-SPAC idea, I want my money back. This is a very quick sample term sheet. Won't spend too much time on it. The example I was giving earlier. 200 million, 7 million is the at-risk capital of the sponsor. If there's no transaction, the sponsor loses the 7 million. There's 24 months to get a transaction completed. The normal feature is there is 1 common share and half a warrant. The warrant stays with the IPO investor, irrespective if they decide to get the money back or they decide to continue. So life cycle of a SPAC, 24 months, as I said, formation. So this is putting the last 3 slides all into one. Formation, target search, acquisition, shareholder approval. then you have two things can happen. Either you get approved or you get rejected. If you get approved, then you start trading as one entity. The SPAC becomes the newco and often takes the name of the company that's being acquired, because in most cases, the majority shareholders, almost in all cases, the majority shareholders remain the old shareholders of the operating company. And the SPAC investors are a minority shareholder. Some investors at that time may redeem the shares for cash, and you can increase the size of the pipe. The second option at the bottom is the transaction gets rejected by the shareholders. The SPAC, the managers of the SPAC are off to the races trying to find another date, because you got 24 months, and that doesn't change whether you get rejected or approved. At the end of 24 months, if you can't get a deal done, the investor receives a pro rata trust value that I mentioned earlier, which would be close with some interest to the initial investment that was made. So, the stage the first round of SPACs today in Singapore is at this stage where you're convincing the de-SPAC target for a Singapore SPAC, Singapore IPO. First and foremost, why go public? So there are pros and cons of going public, for sure. The key things I see for going public is, to be frank, not capital. I think capital today is fairly readily available in the private markets. You know, my day job till a couple of months ago was solely to deploy private capital, private equity capital in the region. And there is an abundance of capital. I think some of the valuations are coming more into reality, which is a good sign for the long-term growth of that business. But it's a lot more than capital. To me, some of the points mentioned here that are of greater importance for someone to want to go public is really, first and foremost, the visibility that an IPO brings, and the assurance for business partners, suppliers, and clients. I think that's huge, because if once you're a publicly listed vehicle, you really can reach out to customers anywhere in the world and say, listen, my life is all open kimono, I'm publicly listed, go look where you want to. The other advantages that I think are very important is you can use your stock to make acquisitions. Now, as all of us know, you can grow rapidly if you have a rapidly appreciating stock. If you're a private company, your valuation is the last valuation you've got. But you've got to convince someone to buy stock if you're looking to make an acquisition at that valuation. But if you're giving them a liquid currency to make an acquisition, which is appreciating, it's a far more compelling proposition. And one of the other things that certainly from a personal standpoint is very important is being able to create an environment where you have ESOPs and have the ability to incentivize management. That's a very important tool, because sometimes in a private context, unless you see rapid growth in valuation, we've seen many a portfolio company management get somewhat frustrated because there is not the appreciation that they were hoping for when they gave up a very cushy job somewhere to be part of a startup. Why Singapore SGX as a public listing location? So, well, we've just done a SPAC in Singapore. We've done a couple in Europe, so this is actually a third SPAC. But having been involved in the consultation paper for the SPAC, as well as being part of the Singapore ecosystem, I mean, I'm showing my age when I say I was here when the first REIT was done in Singapore. So I've seen the whole evolution of the REIT business. I think Singapore as a public listing location is right for many companies in the region. Brand, so I'm going to state some of the obvious things very quickly. Singapore brand resonates well. The most established exchange by a mile, from just basic governance, regulatory framework. Investor awareness and depth is significant. You know, you've got all the big long-only institutional investors, the sovereign wealth funds here. And from a private wealth standpoint, you know, certainly Singapore has seen huge growth in private wealth, partly because of it started off with the EU directive, and then subsequently it has moved and grown simply as there's been greater confidence in the wealth management ecosystem. The less obvious. My view, the right company, not the exchange, determines value. We've seen examples of nanofilm We've seen other examples in the recent past where high growth companies have done exceedingly well. If you are a REIT, and we, from a Tikehau Capital standpoint, we have a REIT here in Singapore, listed REIT. If you're a REIT investor, there's no better place in the world. And in my view, for high growth companies in Southeast Asia and Asia, Singapore SGX has great potential for making that happen. Some of the other exchanges, as you may know, are very geared towards certain focus areas. So for example, I think if you're a business in Greater China, you probably should look at Hong Kong as a potential option and compare it to Singapore. Now, why a SPAC versus an IPO versus a trade sale? Pauline may say, well, if you want to lose money, do that. No, that's not true. The reality is it depends on the quality of the sponsor and what do they bring to the table. Because if you're just going to do a pure IPO to raise money, do a straight IPO. But as I just said, IPOs in my mind are not, going public in my mind is not about raising money. That's one thing. But the reality is there's so many other things. So in my view, where does a SPAC differentiate itself? How does a SPAC differentiate itself? First and foremost, you have to look at the sponsor and the board. What connectivity do they bring? What transactions do they bring? What additional ecosystems do they bring? For example, one of our partners is the LVMH family office. Now, in that ecosystem, they're as good and a solid partner as you can get. It's not about the money. It's a lot more than that. The second is the SPAC gives you flexibility as compared to a pure IPO, where in a pure IPO, it's a much more structured environment where you have to check the boxes. In a SPAC, you can negotiate with the sponsor and have certain earn-outs, certain you have flexibility as a founder to really create something which pays off when you want it to pay off over a certain period of time. It's a much faster way, and most importantly, a much more certain way, which has become obviously very important in the context of the kind of markets we've had in the last couple of months. So in the context of a SPAC IPO, the money is already in escrow. Like I said, the IPO is done. The question is now you're going to do the de-SPAC. In the question of a regular IPO, you have to go through the whole process from scratch, and a lot can happen. It's a much more lengthier process because unlike this two-step process, it's all comprised into one. Compared to a trade sale, to a strategic, or to a sponsor group, a PE group. What I would say here is, an IPO, broadly speaking, gives you a currency for future acquisitions. If you are bought out and taken private, you don't have the flexibility to create that currency to make acquisition. You also retain upside exposure here, and most importantly, you retain control. Because a SPAC investor will always be, like I said earlier, a minority investor. So you maintain control, you get a sponsor group that has enough skin in the game to make it work for you, get you visibility, and at the same time provide the impetus and the ecosystem that you need to go to the next level. Last but not the least, the having abundance permanent capital has shown in the last few months, certainly since the beginning of this year with volatile markets, you do want permanent capital. And folks who don't have permanent capital want more permanent capital, including PE funds, as we have seen. So net-net, what may have happened in the US with certain excesses, we feel with the prudent regulatory regimes that we have in Singapore and perhaps in Hong Kong, I think we don't see a repeat of that happening here. While maintaining a lot of the advantages of working with high-quality sponsor groups. So I'll stop there, and then I just want to put there are no numbers in this presentation, and that's deliberate, or very few numbers. SPACs are all supposed to be all about numbers. I'll point to people who haven't had a chance to look at SPACs in greater detail. There is a section on products on the SGX website which covers SPACs in great detail. And having spent quite some time with it in a past life, I would strongly recommend folks who want to dig deeper to take a look at that. Thank you for your time today.
Thank you, Neil. It feels like I was back at school for a while there. Just to say that having more options can only be but a good thing, and don't believe everything that the Wall Street Journal prints. What I want to say now is on to our very last session of the evening, and a session that will focus on the current state of play when it comes to exits from an exchange perspective and a founder perspective. So what are the key considerations, and what are the options, and what can we expect in 2022? So this session includes audience Q&A, so make sure you get your burning questions into the online chat, and please welcome the co-founder of Tukitaki, Jita, as well as the CEO of SGX, Mr. Bunchai, and also please welcome Elena Seat, President and Director of Nikko AM Asia Limited. Over to you, Elena.
Thank you, Pat, and a shout out to the incredible team at Elevandi. It is a nice evening. Good morning to those of you joining us. It is an honor and privilege to serve this audience and moderate and hear from Bunchai as well as Geeta. So let's dive straight into it. We heard the introduction, Pauline's comments in the front. We heard about the observations from 2021, a lot of it celebratory in nature, very broad-based, very rich, and there were thoughts around, some of that shifting whilst 2022 has kicked off in a very strong way. So let's hear from two different vantage points, maybe starting with Bunchai. What are some of the key trends you're seeing in 2022?
Well, I guess 2022 it started off quite differently from what we saw in the last few years. So for one, it does look like it's a more conservative investment environment. Fed has just hiked rates. There's still the supply chain disruption, and then more significantly, commodity price dislocation, and notwithstanding the invasion of Ukraine. I think the outlook clearly is now a lot more uncertain. That said, even if the Fed were to go through with the dot plots and terminal rates at 2.5% to 3%, that is still low by historical standards, and there's still good amount of capital for, as Neil said, for the right company with the correct business model investment thesis. So I think there's still good opportunities out there in terms of investments.
And Geeta, what are your thoughts from Tukitaki?
I think from a market point of view, as Bunchai mentioned, there is some uncertainties with the Russia-Ukraine front. But 2021, shattered all the fundraising records, and we heard a lot of people talking about it. So this really gave, way to two, I think, potential options for exit, which we are today here want to discuss. One is the mergers and acquisition. I think that became highly prominent with 1,000 M&As happening every month. Our data even says that, from Refinitiv, that 139% growth happened in M&A in US alone. So which means that, and the best part is, companies, venture-backed companies in later stages like D, E, F, they are acquiring smaller players, and that is infusing a lot of capital in the market, which is also, helping companies to grow. And the other point still remains strong is with the IPOs, where 71% founders still feel strong about it. And a little shift, in my view, which has happened in the local Asian markets, is that instead of raising mega rounds, startups, venture-backed startups which are profitable, which are towards the path of profitability, they are willing to go for the IPO or a SPAC. And and they are listing in local exchanges. One very prominent example will be in India, where Indian startups listed in Indian exchanges, which is was not prominent as a story 2-3 years back. So yeah, M&As and IPOs are the two strong, prominent propositions which came up.
So let's tackle, aspects of the tagline for our session today. There was references made to Holy Grail, exit strategy. On Holy Grail, certainly, large parts of the myth are, in the Last Crusade, if you drink from the cup, you granted immortality. But others will say, the cup that Jesus would have drunk from at the Last Supper would have been made of wood and hence long since decomposed. So, Bunchai, talk to us about, exit strategies and Holy Grail. How do you think about, listing as one of the exit strategies from your vantage point? Certainly a very unique one. Help us bring some sexy back. Varun was talking about being sexy in private. Let's talk about bringing the sexy back in the listing space as an exit strategy.
Yeah, I think Neil covered a little bit or quite a lot just now on why go public, why IPO. First, I would say the investors who have invested in startup or any company, at the end of the day, they are there to make money. So so there's a need to balance the option for the investors who really need to monetize, but also balancing the needs of the company and the founder. So clearly, you could continue to stay private. That may be a better choice. Or it could be a trade sale, it could be a roll-up strategy, or it could go via a SPAC or an IPO. And I think each carry different considerations. If I just hone in on a SPAC and the IPO, I think clearly the SPAC has a quicker time to market. Secondly, you get to have a upfront discussion on valuation. And I think that's probably important in the context of a volatile market. In life or in any things that we do, timing probably is key, and timing is probably everything. So in the volatile market conditions, I think a SPAC probably offers you a safer harbor. And also, I think in a SPAC, you probably only need to look at very targeted marketing, your pipe investors, and thereby that's probably a more manageable schedule. But in an IPO, it does carry, obviously, a longer time period, but it brings along with it many other advantages depending on what the company or the founder is looking at. You got succession planning, and frankly, you have a more liquid stock that the price is discovered all the time, that existing shareholders, founders, or even more importantly, employees who are part of making the company successful has a chance to participate in the growth of the company. So I think in the end, there are many, many options. It has to, in the end, a balancing need for your investors and the founder, the companies, and the employees.
And Jita, I guess framing on exit strategy is a bit of a negative framing. Certainly, it's on a positive liquidity event. Certainly, from a founder's perspective, how do you think about exit strategies? Investors and money. Isn't it a little bit like anything you want badly? If you go chasing after it, they run away. What has been the experience? How do you look at exit strategies?
I think exit is not a runaway option at all. Every founder, when they start off a business, founders are like dreamers. They bring reality. They even think of the reality which does not exist. So founders are like that. And, every founder should have a kind of, I won't say it's a strategy, because strategy needs planning and execution, so you need to have a significant control of the outcome, which is not possible, I think, in a startup ecosystem because there are so much of external forces. But I would say an exit potential. I would like to, frame the choice of words, maybe exit potential is important whenever you are starting a business. You need to know your final point of arrival. So it's like, I'll just give an example, maybe, a founder, an entrepreneurial founder in a not so cool business, real estate. Don Carden in Phoenix, Arizona, thought about or dreamt about building a skyscraper. And today it is 1.2 billion, a triple kind of a skyscraper. And he was able to imagine the end before it began. So it's very important from an exit point of view, but it depends on which stage of the business you are. So what kind of exit you are looking for. So that's how I would like to put it, actually. But exit potential is, every founder should think about an exit potential from the day one, maybe he or she starts.
And in terms of, the earlier conversation around, supply of capital, it's really exploded in the last couple of years, prolonged low interest rate. We've had, allocations from endowments, from pensions, the great fund, deployment and formation alongside. There are a lot more options to stay private longer without having to, sort of subject yourself to regulatory scrutiny, cost involved. So how do you think about, these aspects? Certainly, in previous conversations and what we've seen, you can get valuations in the private space today that in the past, maybe you could only get in the public space. What are your thoughts on that?
Well, valuation between the private and the public space. I think capital in the end is global, borderless. The private valuation versus valuation of public markets will eventually converge. And markets do come in cycle. And to go back to the same point, yes, a company could stay private for as long as it serves their purpose. But there is the other balancing act to your investors. And in particular, if some of your investors are from the fund space, whether there's venture or private equity, they are in the game of buying and selling companies and making money, right? It's a 7+2 or 7+3 kind of a life cycle for some of this fund. So you may not have the chance in the end to even continue to stay private forever, because the next takeout by another fund will eventually still need to fulfill that fund cycle. But I also feel that in the capital markets, yes, you can go public, but you can also be privatized. And I think whether you stay public or you stay privatized depends on the cycle. And if your company is going through a restructuring exercise, it may not serve your purpose to be a listed company. And there you may want to be taken private. And we've seen many examples, even on the SGX, where companies were listed, taken private, and relisted again at a higher multiple after they've done their restructuring. So it really depends on the life cycle of what a company wants to achieve.
And Jita, thoughts on experience in terms of private capital, public capital?
I think Tukitaki has experience in private capital only. So as a venture-backed, company, I think it's important that every investor is looking for returns. So we, as founders, we need to understand that we have value to create for investors, team members, and customers. So as I mentioned, that exit potential is imminent, so no founder can run away from it. Based on the stage of the business you are, there can be like 4 options in front of you. That's personally my view. Like if you are a very early stage company, you have built a great product, but you don't want the pain of scaling up, then you can have a acqui-hire option. If you have built, the second option really can be, if you have you have a great team, you have built a great product, and the foundation of your revenue distribution is strong, but you don't, you want a bigger company to help you to get an unfair advantage over your competitors, then M&A is a good option. From a third point of view, you can also become profitable and run a lifestyle business. That's another option actually. And the fourth option, of course, remains IPO. But the fact is, only 6 out of 1 million companies go IPO. So, there is a higher probability for you for a merger and acquisition than for an IPO. But the founder really needs to be, believing in the business and will have a strong capital equity structure to create for the team and the investors if he or she really wants to go an IPO. So I think that's what the options, I personally feel are laid out very clearly, thinking about an exit potential from private to public money.
And as Pat mentioned, we kind of encourage you to put your questions through so that we can try to attend to them. Coming hot and heavy after Neil's comments and building on it, there still is some skepticism around specks in Asia. Many still feel it's only a byproduct of the whole IPO conditions that we've had, and some still thinking very fundamentally on, should I list in the US, should I list in Singapore? Could you give us a sneak peek into, SGX's thinking and vision for this space?
I think Gita make a good point when you ask about the trends in 2022. So one of the trends you noted was clearly companies listing on their home exchanges. And I think same thing with SPACs. Yes, capital is global, but if you just look at the kind of SPACs framework that we created on SGX in Singapore is clearly more international. And then secondly, what is important is the sponsors that we have are reputable sponsors who understand the region. They all have their verticals or pillars of specialization. And depending on the business model of the company, it is important that the sponsors could also add value with expertise, because you could be pick an example, you could be an e-commerce company. For investors in the US, trying to understand how e-commerce rules and regulations work in Indonesia versus Vietnam versus Singapore, it's not easy. And some of these investors may feel that Asia is homogeneous, which is not the case. So I do feel that our SPACs framework, being international and yet being able to attract the good, high-quality sponsors who also have a good portfolio of companies within that, could be a very viable option for companies who are looking to raise public money.
Neil got to speaking about some of this in terms of, I guess a SPAC versus a traditional IPO. Are there thoughts that you have to add to that? Is there a way of looking at it from a founder's perspective? Clearly, in a SPAC situation, your investor is arguably a little bit more sophisticated. Is it more suitable if I have a financial model that is a little less mature for an IPO listing? How do you kind of look at that? Is there, from a founder's perspective, is it just, you mentioned greater certainty in valuation? How do they look at a SPAC in Singapore versus a traditional listing?
Yeah, so for one, you can get into a position of a negotiation. You get clarity with upfront valuation, a shorter window, quicker time to market, reduces the uncertainty, especially in the volatile market conditions. And then what I think you also get is for less of a more complex business model with a sophisticated group of investors, you're probably better able to explain that, and you're also probably able to provide projections and forecasts that is harder to come by in a traditional IPO. So I think it gives the founder the right clarity of space and mind to focus on his business and continue to build, than trying to figure out a right window, what valuation to really come to the IPO market, which has got other advantages, obviously, because it creates brand reputation and probably allows you to have greater credit facilities from banks.
Neil, I think, I think, Neil, 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 I think, Neil And there were references made to dating. In some ways, IPO is a lot like a marriage, right? Not that there's no work up front, but clearly that work happens ongoing, and a lot of it, towards the end. So there in our audience, there are people from the early stage to everything from the late stage. How do we prepare, I guess, if listing, is one of the exit strategies that we're contemplating, and others as well? How do you, share with us some thoughts around how you prepare from an early to late stage perspective?
Yeah, so first of all, I would admire founders who goes through the various stages of fundraising. Fundraising is never easy. It's never fun. So kudos to all of you, whether you do that in the private market or you do that in the public market IPO or via spacks. I think in an IPO, it truly takes, like a marriage, as you say, Alina, commitment. Commitment to really get yourself prepared in the following way, and commitment to stay in the game. Because frankly, if anyone looks at an IPO as purely a destination, that's probably not good. An IPO is clearly a journey, because you've got to continuously to engage your ecosystem stakeholders, including your shareholders. So for one, your system must be robust in terms of financial reporting. At SGX, we did away with quarterly reporting, so there's a lot more breathing room now for companies. It's a semi-annual, 6-monthly reporting, but whichever cycle you're on, I think the financial system robustness of account preparation is key. Two, clearly, you would have to have a solid execution team, because your full planning stage probably is 6 to 9 months before you really get onto an IPO. Investor engagement in terms of your pre-IPO marketing, and then obviously the regulatory submission. But all of that would be worthwhile if you think that you want to begin a journey to be a listed company, because once you're listed, as Neil said, you also have the acquisition currency. On our exchange at SGX, most of our listed companies, in fact, raise subsequent funding in a secondary fundraising, and the amount raised on average is 4 times what they had at the initial IPO, and that really allows them to have further growth capital.
And Geeta, preparations?
I think financials are the most important thing for an IPO. And I think the founders believe to continue post-IPO, because already the founder has spent so many years of effort and journey. A lot of founders don't want that, actually, to be very honest. And, the belief in that he can still create value for the ecosystem, which is now the public investors, team members, and customers. The strong belief and willpower is another important factor. It's a very intangible factor, but it's a very important factor to continue post-IPO, apart from the strong financials, yeah.
Yeah, financials, you can't go back and redo those, right? And coming back to Boonchai on preparation, talk to us about some of the requirements that may be changing in terms of, things to keep in mind as we're making preparations. Are there, changes in requirements from a listing perspective that we want to factor as well?
In terms of ongoing changing in potential requirements?
Yeah.
I guess as with what is going on in the world, climate change is, I believe, an existential risk for the world. And what increasingly investors are demanding is risk to the business model in terms of climate change. As an exchange operator, we have instituted the requirements for companies to have a sustainability report that includes, obviously, board diversity. But I think going forward, which is what we've announced, and many other countries will clearly do that, listed companies will now have to be in a position to explain to their stakeholders, ecosystem, risks of climate on their business model and how sustainable their business model could be in the next 10, 20, 30, 50 years.
You mentioned ecosystem. It was mentioned in the beginning that fintech, to a certain degree, has reached a level of maturity, certainly versus the early beginnings. Maybe we can hear from you in terms of how SGX is supporting the community. And Jita, coming from someone who has a very meaningful presence in Singapore, talk to us about the ecosystem and building a community here.
So at SGX, even though we help companies to raise funds in the public market, to help them come to the public market via an IPO or a spacks, we actually do more than that to help companies. We help them even in a private financing round. We bring investors to private companies way before they are ready to be a listed company. We help to profile companies to investors. We make introductions to a wide array of investors in the overall ecosystem. And also more interestingly, obviously, with Web 3.0, some of these companies that we meet, we put them through some of the platforms where they could raise digital funding via tokenized assets. And then eventually, when they are ready for an IPO, we roll out the red carpet to make sure that they are, the whole ecosystem, their customers, potential shareholders that know them, and more importantly, as I said, an IPO is a journey. Post-listings, we continue to monitor, work with them, profile them, and then help them with the expansions if needed.
And Jita?
Okay, I'll take the question in a different angle because when I and Abhishek started Tukitaki, back in 2015, so our idea was to build safe and sustainable societies. And we wanted to achieve that through empowering financial institutions, be it traditional banks or fintechs. That time, fintechs was not very prominent. Mostly the financial institutions with a robust, compliance tech solutions, mostly in the AML, anti-money laundering space. And because, money laundering or financial crime, there is one human life actually attached in a suspicious financial trail. That's why we came up with this theme of safe and sustainable societies. But now with, I think with the pandemic hitting, the fintechs booming, international transactions rising, and cross-border payments, safe and secure international transactions or payments have also become a kind of a big topic of discussion, where money laundering, we already saw, FATF putting sanctions on, Russia and everywhere. Even UAE came into the sanctions grey list. So there is a huge impact to the society that we believe we can make with our AML compliance tech. And not only the ecosystem, but also to one human life, which we are saving through, however we are aiming to achieve that. So that's how we believe that we are contributing to the society.
Thank you, everyone, for your questions. I think we were able to use the time to actually attend to a lot of the questions. Before we finish, and I hand the time over to Pat, any parting thoughts for our audience here today on our topic? Jita, would you like to go first?
Since it's about exit strategy, the parting thought from my side would be, companies are never, sold. They are always bought. So, most of the founders who were able to get an exit, actually, be it M&A or an IPO, had certain relations. IPO a little different, but M&A, certain relations with the buyer. So although you cannot really plan your exit, but you can optimize for one, I would like to say so, if you are building the relationships, and relationships can always be pursued and deliberated upon. So that would be my parting thought, that do think of an exit potential from early days, and try to build relationships, because chances of IPO are rare. If you are lucky, definitely. But if you're not lucky, then still, you can have an exit and return value to your investors, team members, and customers through an M&A option. Yeah.
Well, I say the capital is fungible. So for the founders out there, I think it's important to create optionality. And each different options will come at different cycle. And sometimes a clear path may not happen because something happens towards the end. So you could continue to choose to be private. You could consider M&A. It could be consider trade sale. You could consider spec or the IPO, but always keep the options open.
Thank you for that. And with that, round of applause. And thank you for Bunchai. And thank you for Jita for your wonderful thoughts.
So thank you to all of the speakers. Thank you for giving up your time and minds to share with everyone today. And so for those streaming in at home or from your office, thanks for joining us too. And one thing I'd like to say is, for those at home, please share your feedback so we can continually improve and do basically ultimately stay relevant. And don't forget to sign up for our next session on green finance using the QR code, I think, to this side, I believe, on your screen. So thank you very much and have a great evening.